Many of our followers like to ask us, what do we think of REITs, right? Because on the surface, and I think the common understanding is that REITs are a lot more defensive, right? They are safer and they give a good 5%, 6% yield, sometimes even higher than that, which is higher than the EPF. But we came across this very interesting article on The Edge that was written by the founder himself, Mr. Tong. Too busy to find stock ideas? Check out FIRL Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description. And he argues that banks are actually safer and more defensive than REITs, especially when it comes to yield or income generation, right?
Yep. So we're going to be looking into what it is his main point, and hopefully we can learn together in this video. But before that, we want to check out some of the price action on these two sectors. So this is the top 5 or the 5 largest bank stocks in Malaysia, and then followed by the 5 largest REIT stocks in Malaysia. And if you look at the year-to-date returns, bank stocks actually underperform a lot. Yeah, especially for CIMB, it's down 11%. Whereas for REITs, the one that it's outperforming the most is IGB REIT, which is right now about 25.7%.
Yeah, so what he's saying is quite contrarian, right? It's very different from what the market's saying.
Yes, exactly. So this is his argument. If you compare the last 7 years of return, right, the REIT index actually significantly underperformed. You can see that the REITs delivered a total return of 39.5% compared to 50.3% for the financial service indexes. And this actually have largely to do to the stagnant of earnings in the REIT sector, and which we're going to be looking into that later. So you can see this is the REITs underperformance over here on the left hand side. He did like comparison between the bank's earnings per share versus REITs earnings per share. So you can see the blue color one, it is the 5 largest banks, and then the orange color is the 5 largest REITs. Obviously, you already can see the EPS, the amount already is huge, and not only the amount, but you can see the growth trajectory also is actually slightly better or faster than REITs. And if you look at the statistics that he have actually compiled, he say that bank stocks, or the 5 largest bank stocks, achieve a EPS growth of 68%, which outpaced the 8% growth recorded
Big
by
difference.
the 5 largest REITs. And you also can see that the banks also are growing their dividends faster, whereby their dividends per share increased 82% over the time, exceeding 23% DPS growth for REITs. So
it's I think a very good segue into what we've been discussing in some of our lives in our FIRL Pro Telegram group chat. And a lot of it is down to what actually produces dividends, right? So the reason that the DPS, right, can increase 82%, which is 4 times larger, right, than the DPS about 3 times larger, 3.5 compared to REITs, is because their earnings growth. It's as simple as that, right? And what Tong is suggesting, which I probably agree, is that give a longer term time frame, 3, 5, maybe 10 years, banks should be more valuable than REITs as a whole.
Yes, exactly.
In short, right? That's how earnings equals dividends equals share price.
Yes, exactly. And also you can see this is the chart for the slower dividend growth by the REITs. So you can see over here, it is already statistically proven that their dividend growth is at disadvantaging the investors over time. And then the reason why a dividend per share in terms of the growth is like stagnant, right, is because they have a very high payout ratio to begin with. Like it is actually a law or regulation that encourages REITs company to pay out above 90% so that they can have some sort of tax exemption. So that's why since the beginning already, they are paying like 90% of their earnings out to the shareholders, which means there is very little capital or earnings left back to reinvest back into the business. So yeah. Okay, so this is the extensive explanation on why the slow growth. Just now we mentioned more than 90% of earnings are paid out as dividends. The second one, which means there will be minimal capital to invest for more properties to grow their earnings, which is rental income. And then the third one is that they also need capital to pay down their debt, because when they actually owning properties, they are using debt to acquire those properties. So which means less cash flow to pay down their debt, which means their finance costs will be at a higher level. Then the fourth point is that in order for them to raise fund, right, one of the ways is actually to introduce dilutive measures. So for instance, a private placement or rights issue. These two are very popular in the REITs, in sector. Actually, this is the only way they can actually raise fund, because the banks are more skeptical to give them money because their gearing rate is actually very high already. So yeah, the only way is just equity financing. And another way that they can raise fund is actually through disposal of asset. But this is the worst one.
Yeah,
it's the worst one. It gives you short-term gain, but then long-term earnings-wise is going to be impacted.
So if you look at the root reason why that all of these things happen, right, it has to do with people's perception of properties. You know, when we think of property, right, we think of it as no-brainer, safe investment. And so there's no chance to reinvest because it's just a property, right? But in reality, there's always going to be investment. It's just, it's like your house renovation, right? Like maybe every 10, 20 years, you have to renovate the place. So because people have this perception that this asset is secured and, for sure it's going to be there always and going to do well. So that's why they are comfortable in paying out 90% of the dividends. And B, they don't feel like they need to pay down the debt because it's the safest asset in the world, right? So why we should max it out? So what happens when you max out everything and then you pay out everything as dividends because that's what people expect from you? Just think about it, right? For those of you who are listening, if you are like a REIT investor, very, very interested, pay attention to yourself and pay attention to the people you know that are also interested in REITs, right? What do you all share in common? I would argue what you all share in common is this desire for income, right? Safe, predictable, preferably higher than EPF kind of income, because that's what you want. So because you guys and investors like that demand this from REITs, that is why they cannot pare down their debt. That is why they cannot reinvest. That is why they have to pay out all the dividends. And of course, in the worst case scenario, looking at the last one, they have to dilute you in the future because actually, doing things is not a good idea, right? We need to have buffers. And the worst, of course, as Jonathan says, is that they will have to get rid of the assets, which in the short term, that's why everyone gets excited, right? Whenever a REIT gets rid of an asset, everybody's like, oh, they're going to pay a big dividend and things like that. But you don't realize that, yes, they may pay a big dividend, but expect the next year's dividend to be less than the previous year's dividend. And if you want consistency, stability, and all that, then the REIT actually becomes less attractive. So you guys are the problem. Just kidding. Exactly. But you let me know in the comments if you agree.
Yeah. So not only just Malaysia REIT, but Singapore REIT also is no better. So we are also about the same thing. The dividend grew also equally slow. But the difference or the good thing about SG REIT is that their net asset value is growing slightly faster only. Okay, so that is the REITs. Meanwhile, banks are actually more steady. So the reason why they are more steady is because it's already in the regulation where the central bank ensures all banks to earn a reasonable interest spread to remain profitable over the long term. And also it will intervene if, let's say, they want to prevent any systematic crisis. So it already gives them like a safety net. And on top of that, there's a strong governance by Bank Negara. So there's some sort of accountability and they ensure that all these banks are doing like good practices, paying out dividends and growing their earnings. So it's just as simple as that. So if you look at 2020's crash, right, if you compare between banks and also the REITs EPS, so for banks, their EPS during that time only dropped about 23%. Whereas for REITs, their EPS actually dropped about 50%. So you already can see that there is a two distinction in terms of these two sectors. But what's funny is that the REIT stocks during the pandemic time, right, their share price actually increased. Whereas for bank stocks, it tumbled down. So there is some sort of like a misperception in terms of REITs because, banks already, they are very safe, but then yet people are still disposing their shares. Whereas REITs, on the other hand, their earnings are getting hampered, but then their share price are down.
So if there's one area of, not to say big disagreement I have with the article, but one area of concern or the lack of highlighting that concern in the article is that, yes, we can compare the EPS and all that. And sorry, remind me again the EPS growth duration. It was over how many years?
2015 to 2024.
So over 10 years. So that's not too bad. But it's important to realize that, banks are quite safe in terms of the regulation, but that may change in the future, right? They may get more aggressive. And of course, each individual bank needs to be assessed individually, right? Because we don't know what is the loan profile. So what the article maybe did not highlight as much is actually the kind of risk that you can get in banks as well. We now, or at least the article is predicting that banks will outpace in terms of share price and maybe dividends, REITs, that's for sure, but the risk is still there. So it's no surprise, I think, that when COVID hit, banks start to face even bigger problem because if you think about it, the worst case for REIT is in COVID, right? No one visits. Right? But it's the banks that have to claim the assets of these REITs because they are not performing. But then if you do that, you run the risk of having your loan, impairing, right? And so the banks and REITs are related.
Yeah,
And the one that, there's a saying, right? If I owe the bank 1 million, the bank owns me. But if I owe the bank 100 million, I own the bank. So there's a saying. So in the case of REITs, they owe the bank hundreds of millions, right? A lot of time. And they actually have the negotiating power compared to banks in crunch moments.
exactly. So that is also the risk for banks. Not everything is like perfect. So the final thoughts over here, probably the reason why REITs outperform banks is because of interest rate cut. So in COVID, there's also a lot of interest rate cuts by Malaysia. That's why REITs went up. Today also, they cut about 25 basis point. That's why REITs also is like performing well compared to banks. So that is the one key thing. And on top of that, right, when interest rates are being cut, banks, presumably their net interest income also will start to decrease because there is lesser interest they can charge to the customers. And the second point over here is that the PE, industry PE for REITs is about 17 times, whereas for banks is about 10 times. So there is some sort of like discrepancy in terms of valuation already. So either the REITs are expensive or the banks are cheap. So yeah, this is just like a simple observation. And the third one is, this is also the reason why that more developers are actually selling their properties and putting it into REITs, because their valuation right now is very attractive. 17 times versus 10 times, right? So you can see over here, already compiled like a few articles, IOI Properties, they are eyeing on REITs to trim their debt. Yongnam also, this is a logistic company. They also want to do REITs for their warehousing. Paradigm REIT, this is also another thing, which is WCT. SP30 also wants to do REITs. So it is some sort of like their asset monetization tool to cash out their properties and to pare down their existing balance sheet in terms of their debts. So yeah, that's also the reason why there's a lot of REIT activity that is going on. Then the fourth point is that the yields right now, the REITs are actually around like 4.8% compared to banks, which is 5.7%. This makes sense because the REIT share price really went up a lot. So if you don't know the dividend formula, it is when your share price start to go up, which is your denominator, then it will actually depress your dividend yield because your DPS is on the top, right? So yeah, right now it seems like if you are a dividend yield investor, right, REITs might not be attractive, whereas for banks, it start to look like quite interesting.
Just pro tip, when you calculate your yield, try to compare it to your purchase price rather than the current price, because that's what counts, right? The yield of, let's say, let's give an example, right? Let's say a house, a terrace house. Today you can probably rent it out for 2,500, 3,000. Let's say it's 3,000, right? So let's say one terrace house today in, let's say, a particular decently affluent area, 1.5 million. So if you take that's 36,000 on 1.5 million, what is the yield on that?
2% each to 3%.
2-3%. Yeah, it's bad, right? But the person who bought this terrace house probably bought it 20, 30 years ago for maybe 300,000. So if you buy it for 300,000 and you compare the 36,000 to 300,000, that's a 12% dividend yield. So I think it's a bit more accurate to compare to your purchase price, because that's what counts, right, at the end. Yes. Unless, of course, you average up, that's a different conversation.
Yeah. So, but if let's say you're planning to still, like, you want REITs or you want to invest in bank stocks just for like diversification's sake, right? Always pick for the largest, because the larger ones, they are always have like some sort of structural advantage. So for banks, it's because their size are more bigger, their distribution also is more bigger. So most likely their funding costs will be much more smaller compared to the smaller banks. Yeah. Whereas for REITs, is because they are already established many, many years ago already. They already have the traffic. They already know, there's a lot of like customers that will be visiting their malls. So they are more established, and their occupancy rate also usually is much higher.
And one tip you can do with your own on-the-ground research is that, so we can see here we have
KLCC,
IG Valley Gardens,
yeah,
Sunway, Pavilion, all this, right? So of course, this is just the big picture. When you go into each of these companies, they own several assets, right? So if you really want to get a sense on which one will perform, what you do is, throughout the week, pick the day and time where in general people will visit the mall the least. So let's say, I don't know exactly answer this question, but I'm going to guess something like midweek, Wednesday, 2 p.m. or 3 p.m., right? You pick that day, and then every week you visit one new retail outlet or one mall, let's say, and you see the footfall. So you want to pick on the malls at their weakest and just go there and then just observe. So I can tell you straight up, like places like Sunway Mid Valley, even at 2-3 p.m. On a Wednesday, Tuesday, or Thursday, there's still going to be quite a bit of people.
Yeah, you can just observe their parking lots.
Yeah, that's another way.
Yeah,
that's another way. And of course, you can go into the mall and see, what stores are, being filling up, and maybe that can lead you into other ideas, right? But basically, pick that at their weakest And that's probably your signal to decide what you are going to buy or not going to buy.
Yes. So that's about it for today's video. And also, yeah, the reason why it makes sense is because they are known over here. You can see this picture. I'm pretty sure you guys visited any of these malls before. So yeah, that's about it for today's video. And this is our FIRL Pro's August update. September one is much better for all three of the portfolios because our stocks are finally like showing some sort of improvement. Yeah. So if you want to know what are the names behind these three portfolios, the Malaysia, the Global, and the Boring portfolio, you can check out inside FIRL Pro. We have a 10% discount link in the description and in the comments down below. But essentially, what is FIRL Pro all about is where we share companies that we find interesting and we think that there is some sort of like good prospects which potentially can, drive up share prices. So that's why we initiate in those portfolios. And also we talk about our analysis, the risks, what is the management like, how's the numbers like. All of those information is inside FIRL Pro. And if you want, dividend stocks besides banks or besides REITs, right, we have other interesting companies in different industries that are paying even better dividend yield and also consistent dividend paying ratio. So this will be inside the Boring portfolio over here. And so far, the dividend yield is about 8.6%. So if you're a dividend investor, you definitely want to check out the Boring portfolio. And if you want to see how we do our write-ups, you can check out our free sample. It's totally for free. The links also will be in the description and comments. And just for example, we initiated KGB in the late October 2022. And since then, it has went up like 4x already and it's still going up. So yeah, if you want to see how we do our write-ups, it's inside over there. And that's it. See you guys in the next video.